Good evening, everybody. My name's Richard Bennett, and I'm Head of Membership at the Institute. Nice to see quite a lot of old faces, but also plenty of new faces for this evening's event. Now, this evening's event is our 9th one that we've organised here in London, and the title for tonight is 10 Years On, Lessons and Open Questions from the Great Recession. And I'll be introducing our speaker shortly. So, the Young Professionals event was launched in September last year, and it's your network, and it was set up to help you thrive in your financial services career. So I would encourage you to get involved in as many events as possible, and enjoy, which you've already done before the event, enjoy the networking opportunities that are available to you. Now, the next event, and which will be our 10th event, has already been arranged, and it's on the 9th of July, at Schroeder's offices in the city, which will include a brief talk on millennials' investment trends, followed by a barbecue on their rooftop terrace. So fingers crossed for weather like we're having this evening. For more information on how to book, visit our YPN website, which is cisi.org/YPN, where you'll also find some relevant articles, videos, and career tips as well. So I'd encourage you to go and have a look at that website. Now, I mentioned earlier that it is your network, and we do want to hear from you. And we want to hear, what do you want from us? What sort of ideas have you got for future topics, future speakers? We want to hear from you. So we have emailed you, and I've checked. I've already got one in my inbox. So there is a feedback form sent to you. So I'd encourage you to, if you've got time this evening, but I'm sure you'll be busy networking and enjoying a beer or a glass of wine, etc. But maybe when you get back to the office tomorrow morning, you'll be able to fill that feedback form in for us. We also would encourage you to continue to spread the word of the network to your friends, to your colleagues, and as I'm sure some of you have done tonight, please do bring them along to future events. We are rolling this programme out nationally, so if you have colleagues in other places in the UK, they too will be having young professional events put on. And we've already held some in Manchester, Bristol, Birmingham, Liverpool, and many more that are coming over the next few months. So, as for this evening, I'm delighted to welcome Danae Kyriakopoulou, who is the Chief Economist and Head of Research at the Official Monetary and Financial Institutions Forum, where she heads up the organisation's economics staff and provides direction to its economics research agenda. And we were talking earlier, and I think there's a number of other topics that Danae would be able to talk to us, which I think will be of interest to you over the coming months. So this work covers areas relevant to global public investment institutions such as central banks, sovereign funds, public pension funds, ranging from monetary policy and financial regulation to reserve and asset management, including the development of new asset classes such as green finance. Danae is a frequent speaker and contributor on these themes in international publications, conferences and the media. And I'm sure we're all very much looking forward to hearing what she has to say tonight. Now, at the end of Danae's presentation, she will be taking some questions, so please do put on your thinking caps and start thinking of those questions now. So I think that's enough from me. I'll be around later on to talk to a few of you, find out how you felt about tonight's event. So without further delay, I'd like to introduce you to our speaker this evening. Thank you very much.
Thank you. You've put me up into some interesting competition there. Summer barbecue terrace at the next event. I'll have to compete with that, but I hope it will be an interesting evening for you. It's a great pleasure to be here and strong links with the CISI and OMFIF, where I work. Your chairman, Michael Colfontaine, is a close friend of ours, and you're very lucky to be associated with him as well. He's a member of our advisory board. So personally, also a great pleasure to talk to you today. We'll be talking about lessons from the Great Recession. I'll be talking about how did it happen, a brief overview. I won't spend too much on that. We'll have time at the end for questions as well. How did policymakers respond? As was said, I work very closely with regulators, central banks, so a lot of my remarks will be focusing on that part of the financial system. What have been the consequences of the response to the financial crisis? How are they impacting where we are now in the cycle? And also, what are the new fault lines that are emerging that will test that system and where we are now? So starting with how the financial crisis started, I'll show you some data, some statistics of how it all built up, starting with the United States, where it all originated. The United States had been running a lot of current account deficits for a long time, fiscal deficits as well. There were fiscal surpluses to start with the war in Iraq. Public finances came under strain, and you can see here in this chart how it all built up to a position where the United States was not very able to respond to that. Spending continued as was not planned because of the war. At the same time, you were having all these budget deficits and current account deficits that the US was running being financed increasingly by foreign investors. And whereas in the past that used to be countries that the US had very close links with, more recently Japan, in the times that we are talking about here, just before the financial crisis, that coincides also with a big rise of China and China's financing of the US current account deficit. So we're seeing big buildup of foreign exchange reserves in China that was increasingly making the US authorities uneasy. At the same time, China's buying of US assets, especially safe assets, a lot of US treasuries, was crowding out other institutional investors that were also looking for these safe assets. So when you have China buying a lot of these assets, what are the other investors, such as pension funds, insurance funds, going to be buying? It creates a lot of demand for financial engineering to meet the demand of these investors that were also looking for AAA products. And that's where you're starting to see this very infamous now subprime mortgage market picking up pace, the mortgage-backed securities becoming and seeing a lot of financial innovation in that way. So that's where the crisis hit with the subprime mortgage market. Here you see the share of the subprime share of the total market, and securitized and non-securitized mortgage market as well. So you see here the big build up at the time after the early 2000s and how it then collapses in 2008. So you've all seen the headlines: Lehman, 158 years old institution, suddenly collapsing, bringing the financial market to its brink. How do policymakers react was the big questions on everyone's mind. Are we going to see insurance funds now collapsing as well? That's September 2008. So a little bit over 10 years, but we're still in that period now. Zooming out and into how that affected the world economy. So there's a lot going on in 2008. I'm going to go through it fairly quickly, but crisis shifting to Europe. When you compare 2002 with 2007, the financial linkages between the US and Europe and Asia Pacific as well, you see here cross-border bank claims between different regions, and how in that period of time they have intensified very much, especially between the US and Europe, that have grown significantly. So yes, on the one hand, the crisis in the US was more idiosyncratic, had to do with the subprime market. Crisis in the Eurozone that I will talk about now had other features. It was the institutional makeup of the euro area that we're still seeing play a very big role today in terms of how the euro area is coping with its own problems, but they were also linked that affected that. So in the case of the euro area, it was a sovereign debt crisis. We had public debt coming up to rescue private debt, quantitative easing programs, bailouts, and so on, that saw this build-up in private debt that occurred in the years preceding. That was a sovereign debt crisis. But not all crises in the euro area were the same. So you've heard about this famous PEAGS acronym. So Portugal, Ireland, Italy, Greece, Spain, they all had very different characteristics. So in the case of Ireland and Spain, for example, it was very much a banking crisis, but also house price crisis. Very different characteristics to, say, the crisis in Greece, where we had a crisis of public finances, irresponsible governments, statistics that were not corresponding to what was really going on in the economy, I'm originally from Greece, so I can also answer questions on that in the Q&A sessions if you're more interested. A crisis that really dominated the headlines in the case of the euro area and the institutional makeup of the euro as well, when you have countries with very different economic characteristics coming together to share a common currency, removes that very valuable tool of the exchange rate that countries can use to devalue their currency and work their way into an export-led growth solution to a crisis. So that was not available to countries in the euro area, and as a result, Greece was one of the countries that suffered and suffered the most. So you had 25% decline in GDP, around a quarter of the economic value of the country was lost over the period of the crisis. So I'll move to part two. How did policymakers respond to this crisis? So central bankers, this is the biggest constituency that the organization I work for works with, were the big heroes at that time, bailing out the financial system through pumping money, through quantitative easing programs. So again, you see different paces between the central banks, the major central banks of the world, so the Bank of England and the Fed being the ones that moved ahead more quickly. That also goes back to the first part of the presentation. It was mainly an Anglo-Saxon crisis to start with, London and the US starting with the crisis there, and then the ECB was the latest one to join the party. It was even raising interest rates at part of the crisis in 2011, and then it moved to implementing its own quantitative easing program. And thinking about where we are now, the Fed and the Bank of England have completely gone into tapering and stopping their quantitative easing programs. The ECB is still now going into reinvestments and continuing with its program. The Bank of Japan as well also was part of that. Japan has been a very different case. It has gone into even more innovative measures with trying to support the recovery in its economy, aging populations, but also new monetary measures that they've introduced, such as targeting the yield curve, for example. At the same time, China was continuing to grow very fast. It was doing so through financing a lot of infrastructure projects internally, building a lot of cities, roads, bridges. A lot of the time, doing that to put its people to use, so its own supply chains, to have very low unemployment in a country that is a regime that is dependent very much on economic prosperity for its population. So China was growing at a rate of 6, 7%, 8%, double-digit growth if we go a bit further back. And as a result, in some cases, household and corporate debt was increasing. But there wasn't really a problem. A lot of the debt in China is held domestically. But once the returns to these investments were going down, which is something that has been going on over the past 4 or 5 years or so, China started to see that it needed to look abroad for more returns, because when you've built a lot of roads, of cities that no one is living in, that roads that go to nowhere, there is limited returns to that kind of investment. So we're seeing a response to that with China moving into more foreign investments, including a lot in the UK, investments such as buying up UK infrastructure assets, for example, stakes in Heathrow, Manchester Airport. Even the company that manufactures the black cabs in London is owned by the Chinese, but at the same time, other parts of the world as well. So the Belt and Road initiative that the Chinese government is pushing now to connect Europe with China through the old Silk Road. Going back to the response to the financial crisis, that was also an effort to fix the financial infrastructure. So one of the things that central banks did, initiated by the Federal Reserve in the United States, was this central bank swap line. So what do these do? The Fed is able to lend money to central banks around the world directly that they can then pass on to their own banks. So initially the Fed could give some money to the banks, say in Europe, but once these limits were reached, they had to find a new system to do that. So these swap lines were established, and as you can see here in that chart, they were with the ECB quite a lot. That's even off the chart. That's why there is a label at the top that they were even higher. And also some other banks in Europe, the Swiss National Bank, the Swedish Central Bank, for example, Danish Central Bank, Norwegian, that got a lot of money directly from the Fed. There is still a lot of direct swap lines, and now it's something that's been taken even further, so there's a lot of swap line to the renminbi now as well. Financial regulation, so The Basel Committee the Financial Stability Board was chaired by Mario Draghi at that time, to provide new regulations and to strengthen the Basel regulations for systemically important financial institutions. Some financial institutions were identified as systemically important and had to have new capital requirements. So here you see some headlines on how banks were the weak link of the crisis and what the response to that was. And here you see how the capital ratios were gradually increasing over that period. At the same time, emerging markets have built a lot of buffers. They had their own memories of financial crisis to work with. The Asian crisis, where a lot of economies in Asia were exposed to high current account deficits, high levels of external debt. They didn't want to be as exposed again. The financial response to the global financial crisis by advanced country central banks meant that because interest rates were put down very low, because of quantitative easing by the Federal Reserve, by the European Central Bank, by the Bank of England, returns on traditional assets such as bonds in these advanced economies were very low. So a lot of investors were moving to emerging markets to search for yields. A lot of capital was flowing into emerging markets. These markets were thinking, well, what will happen when this reverses? We need to have stronger capital buffers to support the value of our currency when this capital flows away. So when you talk to emerging market central bankers today, they say we're now in a much better place. We have current account surpluses. We have high levels of foreign exchange reserves that have been built up over that time. And we are in a much better position to address any such issues. Of course, there was a taper tantrum at the time of Ben Bernanke, where there was a hint that the United States Federal Reserve was going to stop its quantitative easing program or taper it. That meant that a lot of capital flew away from emerging markets, and this was tested. But still, we have seen some emerging market crises since then. More recently, in the summer, we saw Argentina, Turkey, Brazil, but these tend to be more idiosyncratic, and overall, emerging markets are now in a better place than they were at the time of the Asian crisis. But have we done enough? So Mario Draghi, July 2012, London said, we'll do whatever it takes within our mandate to preserve the euro. This was a very key moment in the time of the euro area crisis. You see here very clearly the effect it had on Spanish and Italian bonds. It's something that calmed markets down. They saw the European Central Bank is finally getting its act together. We're finally seeing some support from policymakers that is needed. But quantitative easing programs and exceptionally and unconventional and low monetary policy has also had some side effects that have not been properly studied to date, but you can see in some charts that these are linked to these policies. So for example, asset price inflation has continued. Markets have felt reassured that the recovery is being supported by policymakers. As a result, you've seen the stock market holding up even during times of significant policy shocks that were unexpected, such as Brexit, such as the election of Donald Trump in the United States. Yes, there was some effect in markets. There was some effect in markets in China, for example, when the Chinese economy was looking like it was slowing down in 2015. But overall, the trend has been one of upward looking. Apart from more recently, 2008, markets had one of their worst years since the financial crisis. But overall, that's more recently linked to the trade war. The trend over this period has been one of markets holding up. And many other asset classes have also seen asset price inflation, so house prices, especially overall wealth. It's something that has been going up over time, and I'll talk later about cycles and how going up means that it could go down at some point soon. And markets have been used to easy credit. This is something that Donald Trump has said back in September 2016 before getting elected. He's since changed his mind a little bit. He's now less happy if the Fed wants to tighten rates. He's had various conflicts with the chair of the Federal Reserve, Jay Powell. But even Donald Trump was saying that markets have gotten used to easy credit. The Federal Reserve is distorting the markets, and that's the only thing that's keeping up the economy. At the same time, central banks were what was someone called the only game in town. They were the only policy-making institution that was responding to the crisis. They were not supported by fiscal policy, the other lever that policymakers have, or structural reforms. So governments were not spending, some of them did not have the room to spend. Especially across the euro area, there were many governments that, because of the sovereign debt crisis, were constrained in terms of how much they could push. They were also constrained by the Maastricht criteria, the Stability and Growth Pact, that suggested that they could not spend any more than 3%. But even countries that had room to spend, like, for example, Germany, were constrained by their own financial and economic characteristics. So an economy like Germany that has a very strongly aging population, demographics that it needs to save for future generations, that is very close to full employment. It was very hard for it to justify domestically that we have to spend more of our surplus. Even though we have a surplus, there is a very good reason for why, for us, for our economy in the way it is operating now, we need to be operating a contractionary fiscal policy, or a budget, or a balanced budget. So other policy levers were not moving. Central bankers kept saying again and again, well, we need more structural reforms, we need fiscal policy to work again. And it was convenient for governments in many ways to shift the weight on the central bankers to do the hard work, to support the recovery, and to be the only ones that had to do this expansionary monetary policy that led to the asset price inflation that we saw before. But central bankers by themselves were not able to completely support the recovery. As you can see here, the growth rates that were seen in 2007, much stronger, much faster, accelerating growth compared to the average that we've seen over 2015 and 2018, except the US, which has seen a recovery after that. But in most countries, you see growth now slowing to what some have called a new normal, of a new low. Growth that we have to get used to. Part of it is driven by weak demographics, that by the fact that there hasn't been enough spending and structural reforms, but it's a striking comparison. At the same time, you've also seen widening inequality. So here you see, for example, the difference in the trend between corporate profit and wages. That is fueling some of the discontent of some people that have felt left behind by the economic system that we have right now, that is leading to some of these political upheavals and political polarization that we're seeing in different parliaments. So the US has been an exception for that. So here you see some tweets by Donald Trump suggesting that he's very eager to start moving the fiscal policy lever again, and he did some of that. He didn't do his big infrastructure push through building walls and so on, but he has gone into tax cuts, into expansionary fiscal policy, which pushed up the US economy, but only briefly. As you see here, the forecast by the International Monetary Fund suggests that this stimulus effect is likely to fade out. Even though the US is growing now at a fairly healthy pace, it's something that is not going to be sustained. Fiscal policy can only have a fairly short-term effect when it's through tax cuts and the various policies that Donald Trump has put in place. I also mentioned structural factors, so what can these be? Demographics is one of them. Here you see the dependency ratio, so dependence as a share of a working age population going up in most of the key markets we've been talking about. This is something that is creating this idea of a low for longer and new normal, and some have even called this secular stagnation, that we're not going to see the growth rates that we saw before the financial crisis. Infrastructure, another structural factor. Quality of infrastructure among G20 economies is much lower compared to what it was in the past. Countries like Germany are suffering for very low quality of infrastructure, and citizens around the world in polls that the World Economic Forum does on how do you see the quality of your infrastructure have reported declines in that. So the UK, Germany have aging infrastructure. They invested a lot. They had a big infrastructure push at earlier parts of their history that is now aging, and there has been no money to invest in that. So where are we now in the cycle? This is a chart I like that looks at the average unemployment rate across G7 countries. And you can see historically that when we've seen a trough, and it's very hard to know when you are at the bottom point, but usually after such a protracted period of declining unemployment, you usually see a crisis. So there is a financial crisis in 2008, the dot-com crisis, different crises that are hitting at the point where the economy seems to be doing very well. And it's a cycle. It goes up and it goes down. And are we now at a time where we will see another crisis? The markets have been worrying for a while now that we are close to the next downturn. Central bankers actually, even today, you saw the statements from Mario Draghi at the European Central Bank's Monetary Policy Council meeting, saying that, coming out and saying, well, we're quite surprised that that's what the markets think. We are pushing more into supporting the recovery. He announced that the ECB has even more tools at its disposal to act if needed. I'll talk a bit about that later, but it's policymakers are pushing the message that the global economy is well prepared, there are buffers, and if we see a downturn, it's something that can be managed. It's not going to be a crisis. Economists are traditionally very bad at predicting crisis, so I'm not qualified to talk to you about that, but it's the narrative that policymakers are pushing. And non-performing loans, weak banking sector, especially in Europe. So here you see the share of non-performing loans as a share of total loans. For example, in Greece being as high as over 40%. In countries like Portugal, 12%, Cyprus, 20%, so still very high in some markets in the euro area, having a very weak banking sector. A lot of the discussions right now about how we're going to reform the euro area have to do with the banking sector. The completion of the banking union, for example, how do we break this doom loop between the sovereigns and the banking sector? There were the cases a couple of years ago or last year with the Italian banks in the Veneto region where we saw that system tested. And now we're also seeing a bit of big changes in terms of who is in charge of these institutions. Through the European Parliament elections, a lot of musical chairs. Who will be the next president of the European Central Banks? Who will be the new president of the Commission? The European banking supervision authorities and so on. So it's something that is very much part of the next agenda. But even though central bankers were in that mood of we are going to now return to normality, we're going to gradually raise interest rates, remove quantitative easing, even the European Central Bank a year ago saying this is very much the path we are taking, new economic risks on the horizon, namely the trade war, has taken them back to a more dovish stance. So the more recent statements by Jay Powell, President of the Federal Reserve, by Mario Draghi, President of the European Central Bank, saying that we do see some risks on the horizon, these trade issues and the implications that they may have on the economy. The economy is resilient, but there are risks on the downside. This is very much the message that we've been seeing from central banks. As a result, they've moved back to being more cautious, pointing out the additional measures that they could have to support the recovery. So the agenda to strengthen the euro area, I mentioned the banking union is one item on the agenda. This was something that President Macron of France was pushing for very much. How do we reform the euro area? It's a union that is not making sense at the moment. You have very different countries sharing a common currency, but at the same time you do not have a fiscal union, you do not have a political union. We need to complete the economic and monetary union's architecture. So things like the European Stability Mechanism, an important institution that played a big role in the crisis of the euro area, especially the rescue packages for Greece, needs to be strengthened into a type of European monetary fund. The Europeans had to rely a lot on the IMF for their programs of rescuing the European economies. They wanted to support their own institution to become a kind of European monetary fund. A euro area budget and a European finance minister, this was something else that Macron had very much on his agenda. The banking union, a common deposit insurance scheme. So these were discussed between Macron and Merkel at the Meseberg Declaration, but since then Macron had his own issues to deal with, the Gilets jaunes, the internal political difficulties that he has faced. So this agenda seems to be very much perhaps not put completely off the table, but somewhere in a Eurozone drawer that may come up now as we see these new musical chairs being filled and different people taking charge in Europe. So where are we now and what are the future risks? So here is a list of the top 10 risks for the future that the World Economic always does this survey every year at the annual meeting that they have in Davos in Switzerland, asking people what are the top risks on your mind. So economic confrontations, the erosion of multilateral trading rules. So the conflict that we're seeing between the US and China, trade wars, is something that is very much on top of mind, but also more forward-looking issues such as cyber attacks, digital resilience, climate change is something that's coming up a lot very much and is impacting the investment outlook as well. political polarization and populism as well. So fragmented politics, issues that need the world to come together to solve, such as climate change, cybersecurity, and at the same time you're seeing increasing confrontation. And here you're seeing the latest results of the European Parliament elections with Eurosceptic parties gaining seats. It's a mixed results to interpret. I'm not going to attempt to do that. You, of course, had other results as well, the gain of the Liberals, the gain of the Greens, but it was a fact that the Eurosceptic parties also gained some seats. So at the same time, you're seeing central bankers becoming increasingly worried. You can see them feeling worried here, that they are becoming targets of political attacks. Central bank independence, something that was very hard fought for and earned back in the 1980s, saying that central banks have to be independent. We do not want governments to push us into pursuing expansionary policies. We have to care for financial and price stability. We have to be independent to have a horizon independent of the government. Now that's coming under attack in many cases. So here I have some headline examples from, for example, the Banca d'Italia, where the government has even suggested that we want to manage the gold reserves of the Bank of England, the Bank of Italy do not belong to the Bank of Italy. We want to take that into the government. The latest news from the past few weeks that have been going on for some time before that of the mini-bots in Italy initiating a parallel currency, again, moving into the domain of the central bank. In the case of Greece, there's been several rows between the governor of the Central Bank of Greece and the government. In the case of Mexico as well, new president there, López Obrador, has put a new law in place saying that I, as the president, want to cut my salary by 60%. There is a law in Mexico saying that no one can earn more than the president. The central bank is saying, well, we don't want to cut our salaries by 60%. We're an independent institution. We have to attract very high-quality staff to do these very difficult and complex operations. We have to compete with the banking sector. We have to have high salaries. So they've taken the president to the Constitutional Court to see whether their status as an independent institution means that they can protect that. Fed president as well, having a row with President Trump, and also a more recent candidate from the Fed talking about the Fed's power over the markets. And there is a book, Unelected Power, about central banks having taken too far this idea of independence and being unelected officials that are actually taking decisions that should be taken by elected officials. I mentioned earlier quantitative easing, its impact on inequalities, on asset allocation among different parts of the population, and how wealth is distributed. These are things that something should not be affected by central banks. These are decisions that should be taken by governments. So this is a very active debate in the world of central banking right now, and we may see that taking more pace in the next few years. There was also the German government taking the European Central Bank through the German Constitutional Court to the European Court of Justice over its quantitative easing program. So a lot of issues involving central banks, governments, the justice system that will only intensify around the world in emerging and advanced economies. So moving back to China, I said earlier I'd talk about the effect of that. So China's growth has for a long time been based on high credit growth. It has been something that policymakers there, because of their political system, being able to pump money into the economy whenever growth slowed down, having these so-called growth targets that they want to pursue, and when they don't meet them, they can just expand through fiscal policy, spending on infrastructure, but at what cost? It's a slowdown that is how easily can they manage. So when you have growth that is based on high credit creation, is that something that you can get out of? So China's economy is slowing. Some people see that as not necessarily a bad thing. It's an economy that is transitioning, that is maturing, that is shifting from being an economy that is very much based on a model of export-led growth, of investment, to an economy that is more mature, where it's based on domestic consumption, on imports as well to an extent. But can it slow down? Can it transition successfully without seeing a crisis? This is something that a lot of observers in the West are worrying about. Imports have been growing, so we see that transition happening. We see that rebalancing happening when you look at indicators such as cinema tickets, for example. Chinese cinema tickets have been growing very fast. It's indicating that the middle class is really becoming more important in that economy. So I'll just have a couple more slides on the future challenges as we see them in our work with central banks and policymakers. So one is digitalization. Here's an example from Sweden, the use of cash and the use of mobile payments. So the third set of charts at the very right is the Swish payments. This is a Swedish mobile payment system. So you see the very fast growth that it's seen over time, and at the same time the decline in cash. Sweden is an exception in that it has seen a very, very fast decline in cash, but it's something that we're seeing in many other economies as well. So central bankers are thinking, should we move to a situation where we issue a digital currency? Are we playing around with adopting blockchain for our own payment systems? So there's differences there between retail digital currencies and wholesale digital currencies. So retail means that anyone can open an account with a central bank or can have digital cash in their wallet. That's something that Sweden is thinking about, but we're still very far from that. There's big implications for central banks if you want to lower an interest rate to a negative rate and there is no physical cash, no one can take it and hide it under the mattress to protect their value. It's something that can enable these policymakers to really start charging negative interest rates. On the other hand, there is the wholesale digital currencies, which means that central banks can adopt blockchain for their own interbank payment systems, so just upgrading the technology of their systems. This is something that we're seeing several central banks experimenting with, for example, in Japan, in the European Central Bank, in Singapore, in Thailand, in Saudi Arabia, something that is very actively on their mind. And the other big future trend that we're seeing is that of climate related investments and climate risks to financial stability and economic outlook. So if you looked at central banks 10 years ago, climate change was not really on their horizon. In emerging markets, some central banks were thinking about that. Some financial policymakers were thinking about that. They were more prone to natural disasters, to economic costs from climate-related events, but it really changed with Mark Carney's famous Tragedy of the Horizon speech. And when you look at central bankers' speech that focus on climate change over the past year, there were 20 speeches from central bankers focusing on climate change. You wouldn't really think that these are issues that matter for the economy 10 years ago. But they identify at least 3 channels through which climate can affect financial stability. So the first is the so-called physical risks. When you hold a portfolio of, say, infrastructure assets, of real estate assets that suddenly are subject to a greater level of natural disasters, how do you account for that risk? When you look at the sovereign bond rating of sovereign bonds you're having in your portfolio, if there is suddenly a natural disaster, how do you account for the fact that this government will have to suddenly borrow very much to cover for that? And it's not just disasters, it's also the gradual change in temperature. So economies that are relying on tourism, for example, in ski resorts or in sea resorts, that assets as well, infrastructure, real estate, but also governments will have to deal with that. The second channel is the liability risk. So insurance companies that will have to underwrite such losses, are they able to do so if people build in an area that is suddenly more subject to change or catastrophes? And the third is the so-called transition risk. So if governments have committed through the Paris Agreement to limit the rate of carbon, how can we finance that? What are the risks to different businesses in accounting for this? And here you see the increasing frequency and level of economic insured and uninsured losses from climate-related events. So we're seeing a big trend in public investment institutions that I was mentioned earlier is the group that we work closely with, sovereign funds, pension funds, increasingly shifting their portfolios to sustainable investment. But it's an area that is very fast growing. We could do a whole other talk about this, so I'm not going to talk more about it, but it's an area that requires a lot of harmonization of standards, of taxonomies, of disclosure, because it's a market that's still very new and it's not properly regulated yet. So I'll stop there. I think I've given you a lot of food for thought, and I'll be open to your questions for the rest of the time. Thank you.
Thank you, Danae. There's plenty of time for questions. What I will ask, though, is if you could wait for the mic. There's a couple of roving mics here. So who would like to ask the first question?
I hope it's a straightforward one, and it's actually for you. Will you be distributing the slides to the attendees?
I think we...
Yeah, I think we can do that.
Thank you.
Yeah, sorry, it's not very easy to look at everything, and we went through it quickly, but you can look at them again.
Another question.
Given
Yeah, I'll take a few questions at a time, and then,
there we go.
yes, please.
Given the amount of QE in the system over the last 10 years, why do you think we're not seeing inflation? And do you think that it's coming down the track?
Okay, I'll take another.
When do you think the next correction is going to be due?
When?
Yes.
Okay. Yeah, I'm not going to answer that because that's a $1 trillion question. If I knew that, I wouldn't be here. I would probably be somewhere enjoying the results of my investments. But no, I think a lot of people are very worried that it's coming soon. I think it depends very heavily on the political events that are hard to predict, like trade wars. Are we going to see that being the trigger? But then again, as I said, we've been increasingly proven wrong about this. So there were political events that hit that were not expected, like Brexit, like Trump, and they did not cause a correction in asset prices. So I think if we do see central banks really returning and starting to tighten the screws on the global economy, that is something that could be slowly lead to a downturn. I think China's slowdown is another big event, and again, Brexit is something that could still turn out in a way that we're not expecting. I think also if the euro area doesn't get its act together this time, there's a lot of talk about the need to reform its architecture. I don't think the next time will be as easy as this time, because last time what really held the economies together and what was very crucial ingredient in the response to the crisis was this very strong political will to hold the euro together. So a lot of creativity, ingenuity to how do we solve this crisis, a lot of new measures that had to be taken. And it required very, very difficult decisions by policymakers to go back to their parliaments and say, we have to do this because we have to preserve the euro. When you have leaders in Europe now that are perhaps not as strong, that are perhaps coming from parliaments that are more fragmented, they may not have the same ability to do that. And I think if Europe were to be tested again, we are now in a weaker place in a sense. But when we look at the pure macro data, one may conclude we are now in a stronger place because we have all these new tools. The European Central Bank has strengthened its toolbox. Yes, there is less room for central banks to cut in a next downturn because interest rates are now already very low. But at the same time, they've come up with new instruments that they are still able to use. And on inflation, yes, I didn't mention this very much in my talk. Thanks for bringing it up. It used to be that the big fight for central bankers was how do we fight inflation? How do we keep prices stable? Now it's almost the opposite. There was even a period a few years ago where they were seeing the economy flirt with deflation. So the new battle for central banks has been how do we get prices up? And you even hear central bankers saying, well, we need to have stronger unions, we need to see stronger wage growth, we need to see parts of the economy and employers paying more because that's where inflation has to come from. One answer to that is the so-called flattening of the Phillips curve. There is no longer such a trade-off between inflation and unemployment. Even though we have record lows of unemployment, we're seeing inflation still be very, very low. And it could be due to various reasons. One part could be that it's a productivity issue, that we're not measuring it right, that there is different parts of technology now that are higher quality, but the prices are not necessarily shifting. So it's a mix of factors that explain the low inflation. And others is that we are now in this phase of lower for longer, and we are in a phase of secular stagnation, of weak demographics that mean that this is the economy we're in.
Any more questions? I have one whilst the mic is going.
Yeah.
One of the things that hasn't been touched on, one of the issues of the last 10 years is I suppose the loss of trust the general public have on the financial services sector. So what do you think the central banks and firms, I suppose us as well, can do to sort of help improve that level of trust from the general public?
Mm-hmm.
Emma, I think you've got a question.
This is obviously a very simple way of looking at it, but you gave the example with the unemployment slide where it sort of gets to a trough and then it goes up and then it comes down, and it's a clear sort of 10-year sort of gap in between. How or why are we not learning? Is there not, obviously it's not like an equation, this plus this plus this equals recession, But it seems like there's a 10-year gap and then something happens every time and we go up and down and up and down. Why is it not more steady? Why are we not learning the lesson?
Mm-hmm. Okay, I think we're constantly learning. I think that is part of the lesson of my talk, maybe, that we're always learning and reacting and strengthening the infrastructure that we have. We're seeing what has not been working. Banks need more capital. There's new rules. Then these rules perhaps go too far. We revise them again. So I think we are constantly learning. I think there's always going to be these cycles. The question is, how do we make them smoother? So if you think back to that slide, now we're going to a period where unemployment has been very, very low, and perhaps the change is bigger than what it has been in the past. I think you can never really avoid that. That's the way the economy works, but it's about how do we make it smoother. And on the reputation, if you like, and trust in the financial services sector, yes, absolutely. It's a sector that has suffered a very big hit from the financial crisis. You see that a lot of students of economics, of finance in the younger generation are feeling increasingly less inspired to be part of that sector. But I think, as I showed in my last slide as well, it's a sector that holds a lot of potential to make big changes for the future of the planet as well, with climate-related investments, with sustainable investments, with ESG type of investments. And it's about how do you regain your reputation, and about trust into the financial system. That's an interesting topic, because central banks themselves are losing that. You're seeing now in the headlines that Facebook may want to issue its own currency, that perhaps millennials trust Facebook more than they trust the Bank of England. So how do we get over that, and how do central banks retain their core value and their core role is something that they are thinking very hard about.
I'll take one question there, and what's that question on the front here as well, James?
Hi, you mentioned about regulation and how that's played over the since the crisis. Can I just ask, what do you think in terms of the state of the regulation? Has it gone too far? Has it not done enough? Is it about right? Where are we on the kind of the curve? Thank you.
How much do you think that central bankers are now targeting asset prices rather than inflation? And do you think that's a trend that's set to continue? And how does that differ between the US and Europe?
Yeah, I think we're increasingly seeing the use of these so-called macroprudential measures that are targeting directly certain asset prices. I think central bankers are themselves finding that challenging, the new era where inflation is no longer their main problem. But I think as an economist, and I think this is also the consensus among economic circles, that you have to not think that this time is different, and inflation is still something that had been enjoyed stable price stability over a long time, but it's a risk that we could go back to a point where central banks have to fight again their normal war of inflation. And what institutional setup do they have then if we now conclude that central banks are irrelevant because inflation is low and we have to instead work more with macroprudential measures? What do you do when inflation starts going up again and then you don't have the institutional setup in place? I think macroprudential measures are working in certain economies that have issues with specific asset classes, but at the same time, you also get the view from some central bankers that we don't want to be moving too much away from our core mandate. Even these climate regulations that I mentioned, there was the Network for Greening the Financial System that central banks set up in December 2017, and is now grown to 36 members, that is saying because climate risks are financial risks, we have to take action and direct more capital into climate-related investments. But others are saying, no, this is not really our role, and even though there may have impact through if weather effects have bigger food supply shocks, for example, that lead to inflation shocks, this is more peripheral and we need to stick to our core mandate. And on the issue of regulation, I wouldn't say I'm a big expert on that, but I think it depends again on jurisdiction by jurisdiction, and the Basel Committee on Banking Supervision based in Basel are constantly revising that as well, and I think we're perhaps, some are saying we're not far enough still, so thank you.
Yeah. I would like to know your take on a hypothetical scenario. So do you think if the Fed were to deploy Fed-backed cryptocurrency, do you think we'll ever see people accessing credit without using bank intermediaries?
Mm-hmm.
Very long term. Thank you.
Thank you. I know very little about economics, but I was just wondering, to what extent do economists factor in political risk into their projections? How do they go about doing that, and how is that changing, or is it changing now that we're seeing sort of the political landscape get more fragmented and perhaps some of the big players more unpredictable?
Yeah, it's definitely making the job of economists more difficult, the fact that politics are unstable. But there's never been a time where it's not been uncertainty. I mean, when you talk to policymakers over the past 10, 20, 30 years, it's always been a time of uncertainty. So to think that now we're in this exceptional time where we cannot predict the future, that's nothing new. I think political risk is very often a factor. I think we're much better at factoring it now into macroeconomic models now than we were in the past. When you think about the times of the Asian crisis, where just because Thailand was doing badly, suddenly investors were thinking that everyone around it, just because they're in the neighborhood, must be doing badly, and there is a domino effect. It's not the case anymore. So you're seeing political risk in the UK right now. The rest of Europe is not being affected as much. Or in the case of the euro area crisis, you had measures to make sure that political risk or economic risk in a country like Greece did not affect bond yields elsewhere in Europe. So I think we are getting into a more sophisticated understanding of individual country risk, but at the same time, big risks that affect the global economy, such as the trade wars, are definitely factoring in very heavily into economic forecasts. And on cryptocurrencies, yes, I think that's an interesting question. It depends what type of digital currency a central bank like the Fed might do. If you're able as a citizen to open an account directly with the central bank, I think there would be a role for financial intermediaries like banks. If we're talking about the interest rate, the Fed would not be able to offer the same interest rate that a private bank would. So you would still hold your money with a private bank that can give you more interest. But at the same time, if there is suddenly a downturn, if there is a bank run, do all these accounts suddenly move to the central bank? How do you avoid this digital bank run where banks still are in business, but when things go badly, everyone wants to have their money with the central bank because it's safer? And I think that is a risk that central banks are very worried about, and is one of the constraints why they're not progressing these experiments. And I think Sweden will be the one where we'll probably see doing something like that first. But even Sweden, with this very low use of cash, is still very skeptical. So I think it's something that we're still very far away from.
I think we have time for 2 more questions. There's one person with the mic, and then it's James on the third row back.
Hi. So after 10 years of kind of ultra low interest rates where kind of the incentive is to spend more than save, what's your views in terms of how resilient the average UK consumer is, and does that concern you?
And a similar, following on from that point, if economic growth is struggling to get through with the current tools available, will we likely see the implementation of helicopter money?
Yes, I spoke about the tools that different central banks may have at their disposal, that we've seen very high levels of creativity in the past. Helicopter money has been a suggestion. I think it's more in the political circles than in the central banking circles. It's something that if we were to see a Jeremy Corbyn government in the UK, we may see these kind of measures. I think it's not something that central bankers by themselves would want to implement. I think you're getting into the area of fiscal policy, and I think especially with the experience of quantitative easing, a lot of central bankers are worried to not take that too far, especially in the case of the euro area, where we have seen, as I said, the lawsuits and the conflicts with the justice system and politicians about quantitative easing, monetary financing. I think with helicopter money that would be much more active. But I would not exclude anything. We've certainly seen very things that were not expected, new ways to respond to crisis. So it may be a feature of the future. And on UK households, yes, I didn't have a slide on that, but you're right. It's something that they've been used to easy credit, that they are over-leveraged in some cases. So it's something that I think also the Bank of England is very aware of and addressing.
Thank you, everybody. We need to move on. There's drinks and there's some refreshments for you and plenty of time for networking. Can we thank Danae?